Consumer confidence in the U.S. housing market has plunged to its lowest levels on record, as steep mortgage rates crush demand, according to Fannie Mae. And Redfin reported that nationally, 33% fewer homes went under contract this October as compared to last year. That's the largest decline that we've seen since 2015. And they reported that cities like Las Vegas, Miami, and Phoenix have seen pending home sales drop by 50%. Which I can tell you in the Phoenix market, that's a pretty close number. We actually saw 48% fewer homes go under contract this October as compared to last. When consumers don't have confidence in the market, they don't buy. And they also don't sell, because when they sell, they have to buy. Because of this, many are saying we are going to see some stagnation in our real estate market. An economic research lead at Redfin said this: the U.S. housing market is in another standstill. But the driving forces are completely different from those that triggered the standstill at the start of the pandemic. This time, demand is slumping due to surging mortgage rates, but prices are being propped up by inflation and a drop in the number of people putting their homes up for sale. Many Americans are staying put because they are already relocated and scored a rock-bottom mortgage rate during the pandemic, so they have little incentive to move today. The run-up in our pricing in the real estate market over the last 2 years was pretty heavily driven by the investor. And these aren't just corporate investors. These are mom-and-pop investors, as well as institutional investors like Blackstone. We also saw home builders that broke ground on spec homes, and you also had the iBuyers who took a really aggressive approach with paying over market value just so that they could grow their inventory. Now, we all know that our home price appreciation has come down. And here in the Phoenix market, we saw the peak of our pricing in May, and our median home sales price at that point was $480,000. Today, it is $440,000. Now, many want to talk about prices decreasing, which is one of the metrics that we look at, but you also have to look at the number of contracts being accepted. This is all part of the equation when you're looking at the overall health of the market. When we talk about the decrease in the number of pending home sales and how low our buyer activity is right now, it allows us to look forward and somewhat predict where our market is headed into 2023. This is when we look at our contract ratio, which has been gliding down ever so slightly ever since about July. Prior to that, it was dropping pretty significantly, which is why we saw our prices shift so drastically during that time period. Looking at the investor over the past 2 years and the ongoing housing correction, this has scared many investors to the sidelines and marks the first time that our home prices have actually declined since 2012. But it's not just this. It's the fact that these are taking longer to sell. It is costing them more money, further eating into their profit. And because of this, they really have one option, and that is lowering their prices. And that is why we saw huge losses for these type of buyers in September. Redfin CEO Glenn Kelman said this: the pandemic housing boom's investor frenzy helped explains why home prices are correcting faster this time around. Historically speaking, home prices are sticky. Sellers simply don't want to relent on prices unless economics, like supply glut, force their hand. That's not as much the case for institutional investors and builders. If they think prices are about to drop, they want to get out first. The fact that the pandemic housing boom saw investors become a higher share of buyers, Kelman says, ultimately makes the U.S. housing market more vulnerable to a faster swing down. But remember what I said, it's not all just the prices. It's the fact that buyer demand is down as well. And even though there are buyers in the market, it is almost the flip of what we saw during the last 2 years in the frenzy, when buyers were doing everything they could to make themselves the most attractive to sellers. Now sellers are trying to do the same thing for buyers by lowering their prices and offering seller concessions. There is a little bit of good news though. Redfin chief economist Taylor Marr said this when talking about the rise in interest rates: there is also a glimmer of hope in the data that buyers stopped leaving the market as mortgage rates leveled off this week, but we're still deep in a market that is coping with the pains of higher mortgage rates. Mortgage rates may take longer to come down than many have expected, which means housing trends could continue to worsen as the economy adjusts to higher rates. If last year's housing market was as overheated as Chair Powell stated on Wednesday, when record growth in rates was like a bucket of water poured on the flames to bring it into balance, it may take some time for the smoke to clear to see where things stand next year. What's interesting about this statement is I am hearing the exact opposite from some other analysts. Some believe we could see rates back in the fives by the second quarter of 2023. The reality is no one knows where the interest rates are headed. Everyone is speculating, using numbers they believe will come to fruition. But until that happens, it's anyone's guess. What we do know is that if rates drop into the 5% range, demand will come back, just like we saw in July of this year when that exact same thing happened. And when demand does come back, and it will, this is when we could see some issues because we still have low inventory. Now, many want to look to home builders to bridge this gap, but they have pulled back significantly, not wanting to end up holding the bag just like they did in 2008. So we cannot look to them for this. Now, because I hear so much about prices crashing and people really believe that we are going to see short sales and foreclosures again, I wanted to share this chart with you. This is showing price appreciation over the past 5 years when looking at the price per square foot. If you bought your home 5 years ago, you are looking at an 84% appreciation. 4 years, and it's 68% appreciation. 3 years, and it's 60%. And 2 years, you still have 33% appreciation in your home. It's not until we get to the last year that we are only seeing almost 6% appreciation. Now, I say only. And prior to the last 2 years, 6% appreciation on your home would be pretty decent. But the real thing to note here is that homes that are currently on the market, 65% of them have been owned for more than 2 years, which is still leaving them 33% appreciation. So even if home prices do fall a little bit more, they have got more room and still can walk away with money in their pocket. Looking forward, we are bracing ourselves for our normal seasonal slowdown for the fourth quarter and a buyer's market. Most of the greater Phoenix area is already in a buyer's market to some level, but some are still in a seller's market. And we really believe that is going to shift here in the next few months. As for 2023, the first quarter is going to be very telling. This is when our normal selling season really heats up. I do believe we are going to see more homes come on the market, just like we always do. And I believe that our demand is also going to increase. The good news for buyers is that you now have the ability to negotiate, not just on price, but also for repairs and for seller concessions. And I do think how the investor handles themselves over the next few months with pricing is going to have a big determining factor on our pricing in the overall market for certain price points. Now, if you want to know about what effect the iBuyers have had on our market already, take a look at this video right here. If I can answer any questions for you, please feel free to reach out and give me a call. As always, I thank you for watching, and I'll see you next time.